Good morning or afternoon, everyone, and welcome to the Upstream and Oilfield Services Capital Market Panel webinar presented by Hein Associates. HPS Investment Partners and Oryx Energy Capital are participating. I'm Shannon Reddy, your webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted, so please use our chat feature to ask questions. The webinar is being recorded. A copy of the webinar presentation and recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the panel. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE. Our moderators today are Jimmy Williams and Jim Harden out of our Houston office. This is an interactive panel discussion, so please use the question feature to ask questions throughout the webinar. We thank you for attending today, and I would now like to introduce Jimmy Williams.
Good morning, everyone. This is Jimmy Williams. I just wanted to kind of briefly go through. I think our agenda is. I'll go through a brief introduction of our panel here, and then we will kind of go into a panel discussion, and then towards the end we will also have a Q&A session. So with that. First panelist that we have is Joe Defner, who is a managing director with HPS Investment Partners. Joe's a good friend, and appreciate him coming here. And then I'm going to let these guys go through here in a second and introduce themselves more appropriately, as well as their firm. And then we also have Mark Tharp, who's co-head of Oryx Energy Capital, here with us as well. So. Gentlemen, I appreciate you guys taking the time to join us today. And with that, I would say, Joe, if you want to kind of start off and tell us a little bit about yourself and your firm, and then we'll let Mark do the same.
Sure, appreciate it. So HPS, our firm is headquartered in New York City with energy dedicated offices based both in Houston and Dallas. HPS was formerly known as Highbridge Principal Strategies. Was established in 2007 as a subsidiary of J.P. Morgan's Asset Management Division. Fast forward from 2007 to last year, in March of 2016, the principals of HPS acquired the firm from J.P. Morgan under what was effectively a management buyout, and renamed the company from Highbridge Principal Strategies to HPS. We currently have about $39 billion of assets under management and approximately 100 investment professionals, with a dozen of those dedicated to the energy space. The energy team is a combination of both industry and financial individuals, with averaging about 17 years of experience. So it's fairly seasoned individuals who have navigated and experienced several cycles of both commodity prices and the credit cycles. HPS is primarily a private capital provider with a primary focus on non-investment grade credit, but with the wherewithal to consider equity opportunities. To be clear, we're not a private equity firm. We're not a control equity investor within the space. Typical transactions for private credit firms like HPS are the ability to participate in many parts of the capital structure, such as revolving credit facilities, first lien, second lien term loans, unitranche solutions, notes, mezzanine, prep equity converts, and like I said earlier, opportunistically look at equity opportunities. For guys in our space, we're typically looking at something in a kind of $50 million minimum deal size, maybe to as large as $500 million ticket sizes. A bit of personal background: I've been in Houston for just over 20 years now, about 5 years with HPS here in Houston. Prior to that, spent about 8 years on the banking side, specifically on the commodities desk, so both at Citigroup and UBS. And prior to that, I spent time at a hedge fund and large corporate here based in Houston for over a decade.
Well, thank you, Joe. Well, Mark?
Yeah. Good morning. This is Mark Tharp, co-head of Oryx Energy Capital. Oryx Corp is based in Tokyo, and Oryx USA is a subsidiary. And I won't go into all the details on Oryx Corp because it is a global financial conglomerate consisting of $100 billion of assets under management, and so I'll spare all those details. Oryx USA is based in Dallas, Texas. We are the headquarters office for Oryx USA. We provide middle market and lower middle market, secured debt and select equity capital to virtually every industry here in the U.S. Oryx Energy Capital has been around for 2 years. It was started by myself and my co-head, Jay Mitchell. We exist, really to focus on smaller private debt and equity opportunities. We our check size tends to be between $20 and $50 million a piece, and we focus on secured debt, first and second lien, unitranche and stretch. We look at all aspects of oil and gas investing, including midstream, oilfield services, energy services, and minerals. So we have a pretty diverse set of opportunities we look at, of course, as well as E&P. So I'm pleased to be here. In the first 2 years, we've been investing functionally for the last 18 months. We've got just under $200 million of capital committed, and certainly a lot more ready to go. So looking forward to this discussion, and we're ready to start.
All right.
Great. We have our first polling question to kind of help understand the audience today. Can you please answer the attendees? What are the biggest challenges of your firm? Raising capital for a transaction, sustaining operational cash flow, organic growth, or depressed commodity prices? Please make a selection now. All right, and here are the results.
So I guess leading into some of those responses, guys, maybe our first question here is, what are your views, regarding the current state of both the upstream oil and gas and oilfield services market?
Sure. Well, I'd say I think the polling results are pretty clear there, right? It's the ability to sustain cash flow and grow organically and raise capital is very much predicated in many regards on the commodity prices, and we're certainly struggling through a commodity price cycle that's persisted for 2.5 years now. Some of the key views here is consistently here, $45 is not a sustainable price level, and we've been saying that or people have been saying that for continued, extended period of time now. When prices are retrenching like this, you certainly get more of a focus, retrenching back to, more of the tier one properties, a lot of focus, and you'll see capital flowing there as people move to the lower cost basins. But when you look at some of the global macro type of items, you see things like Venezuela coming apart, Libya, Nigeria coming back on production, but certainly risks of disruption, and yet there's no kind of geopolitical risk premium apparently baked into any of the commodity prices here. Despite all the pressure on prices we've seen for the last couple of years, it's amazing that the North American rig count is still up over 100% in the past year. So folks have been able to drive their break-even costs down dramatically. Efficiencies on both the drilling and the completions and the techniques and the completion technologies there. Been able to just continue to weather the storm amazingly well in the right basins. Certainly, if you're not in the core basins, it's been a different environment. But it's been really surprising how well some of these guys have been able to get their prices down as low as they have.
Yeah. One thing I'll say, understanding that the anxiety around the depressed commodity prices, it really drives deal flow for us in some ways. At Oryx, at least, it's kind of we have conviction around a higher price, long term, and so we find a little bit of uncertainty in the market. I mean, in the short term, to be kind of good for business. Certainly, I wouldn't vote for it long term, but to Joe's point, 45 is not sustainable, and we don't believe that that's the number we're going to be seeing in the next kind of 3 years. On the oilfield services side, it's really challenging, for your core OFS guys because you're looking at negative or break even, LTM EBITDAX or EBITDA, and that's just difficult to underwrite a credit investment too. And so you have to sort of have a view for the future that assumes that there will be some sort of inflation on prices and services and the ability to return to profitability. Otherwise, a lot of this OFS it remains to be sort of a consolidation and or kind of an equity story as far as trying to fix some of these troubled OFS companies.
So Joe, you mentioned a little bit earlier is what do you guys see as from an activity level the core basins that obviously the Permian Basin it appears to be the hottest, but what other areas are you guys seeing significant activity in?
Sure. Yeah, there's still significant activity taking place in the other basin, and certainly, just a couple of years ago, folks were all focused on the Permian, but without a doubt, Oklahoma and the STACK and the SCOOP have become just as competitive there. Certainly, the Niobrara, the Wattenberg, and other areas such as that, the Bakken seems to be getting some life, and we've certainly seen a lot of activity pick up in the past year or so, in the last couple of years within the Haynesville, right? Where you're seeing where we continue to see a lot of activity in the market is a large number of, let's say, the large cap publics have made decisions to divest of non-core assets, and a number of these non-core assets are company makers in and of themselves, given the scale. And in some regards, commodity prices don't necessarily, impact the ability of those transactions to take place. When a large strategic makes a decision like that, the transaction is going to take place, maybe delayed or whatnot, less bidders capable of pursuing it. But when a large company of that nature decides to take action and make a strategic decision and refocus resources and capital on the core assets, those transactions are still going to take place. So we're continuing to see activity in what I'd say, perhaps not the tier one and not the most spoken of core areas. Activity is still going to take place out there.
Yeah, I mean, we've definitely seen A&D drive our deal flow. The majority of our near-term opportunities and term sheets and deals we're trying to get closed are largely driven by divestitures in all aspects, in midstream, OFS, as well as E&P. To your point on break evens, we're working on getting a drill co hopefully closed here soon, and we believe in the good part of the stack, it's we have conviction around a $30 or less break even price, and so I think that's a positive for those areas. But when we think about where we're most active with our secured debt products, I mean, really it's not in the stack, it's not in the Permian, it's kind of in some of the out-of-way parts of the oil field, even including California and conventional gas in the Rockies or Appalachia. I mean, we really we see value in some of those properties as well.
Okay, all right, very good. So kind of going on, and it's a little bit of a follow-on is given the current market situation. I mean, what are the biggest obstacles you're seeing for the OFS and the E&P companies seeking capital, whether it be equity or debt, and what things are you seeing out there in the marketplace that are?
Sure, I'll take first stab at that. As far as obstacles, it's in the past couple of years, if you were in more the core positions, the more the Permian type locations, you had access to the capital markets, especially after the OPEC announcements late last year. The capital markets were open, a lot of people were accessing capital, but for the guys who weren't in some of the more higher profile or lower cost break even points, didn't necessarily have access to that kind of public capital markets. But having said that, even in the past 4 or 5 weeks now, we really haven't seen anything getting done in the energy high yield space. So that market's really been kind of, closed off to folks. Beyond that, where folks certainly, have been struggling, it was in, access to capital in the bank markets, right? The OCC guidelines that were kind of imposed on the banks on the borrowing basis, look more of a focus on total leverage versus secured debt kind of positioning, certainly had an impact on the ability for upstream companies to access more of the lower cost right way, bank facilities. So I think those have been, a couple of real constraints on seeking capital. Now, having said that, there's been a number of ways the transactions are getting done, and frankly, this is the environment where private capital really does, show its value, right? From the perspective, you don't have, outside kind of, regulators, prescribing what the box is going to look like. You're not beholden to the capital markets, open or closed. The private capital, both on the debt and equity side, is there, and it's available in a large way to kind of, take advantage or be available and solve problems in this market environment. A number of the types of transactions, when you say what kind of things are we seeing getting done now, certainly seeing more institutional investors, stepping in and providing some more of the revolving facilities where the banks haven't been able to. We've certainly seen where companies are getting ready for an IPO and perhaps the need a wedge of capital to hit certain IPO metrics they're looking for without layering on debt. So there's been a number of transactions done recently with more of a pre-IPO preferred equity type of a structure. But there continue to be a number of growth financings, whether it's more mezzanine capital or unitranche type capital where guys just want to accelerate their production, whether it's because the economics in their core basins are still very strong, or they are trying to position themselves for the right metrics for an IPO or a potential sale in the next 12 to 18 months, which means stand up rig count, delineate different benches, delineate different parts of your acreage position, and you're not going to do that by stand down rigs in this price environment. So a lot of transactions still taking place and plenty of capital available, but certainly an opportunity for private capital to bridge the gap while the public markets are closed.
Yeah, Joe said everything I would probably say, but one example would be, kind of the CRC, some of this JV Drillco, some of this kind of structured project finance is another way for companies to accelerate growth without having to incur increased, leverage or accessing the equity markets. And I think you'll see a lot more of that, and we've seen several of those deals in the last kind of 12 months.
Okay. Thank you, guys.
We have our next polling question. What is your outlook for WTI for 2018? 40 to 50, 50 to 60, 60 to 70, more than 70. Please make your selection now. And here are our results.
So I guess, kind of continuing on in our discussions is what change, we've kind of been experiencing, this downturn since the end of 2014, and obviously there's been a lot of shakeup in the marketplace and changes in the environment. What are some of the biggest changes that you guys have seen in, both the upstream and the oilfield service markets as a result of the downturn?
I think following on what Joe said previously, I think what the OCC has done on the debt side, is really hamstrung the lenders and the borrowers. Haynes and Boone has actually written a really interesting OCC white paper, and I would encourage everybody to kind of go find that, because they speak pretty eloquently about the dynamic right now. And for Oryx, that just opens up more opportunities.
Right.
And so I think that is a major. Obviously it's a seismic shift. I think one thing observation I can make is I see, I talk to certain CEOs and CFOs, and OCC has made the shift, but some of those CEOs and CFOs haven't. and they're reluctant to maybe take my higher priced term sheet, even though it may be in their best interest. So that's certainly a dynamic. Certainly OCC coming in and really clamping down, like to Joe's point, on total leverage versus net, and then looking much harder at each of these banks' portfolios has been a major one.
Yeah, I'd add that, to follow on some of that, it's kind of required, in some regards, a change of the structures that are getting done on the capital side, right? In the past, where perhaps, a second lien would solve some issues by paying down bank exposure while maintaining, leverage at the opco level. With the guidelines, now you're seeing some of those, what would have been a second lien in the past, being done as perhaps pref or being done as holdco, kind of debt moving out of the borrower itself to kind of satisfy some of the guidelines. So you're seeing deal structures, which does, necessitate a slight change in the risk profile of the credit, moving out of the actual borrower with the hard assets to a different entity. But those transactions are getting done. They're being done, as a kind of a response to the impetus put on by third parties. Other things we've certainly seen through the downturn here is, additional other changes to deal terms and structuring. Where in the past perhaps you're comfortable with a first lien, second lien structure, the introduction of 1.5 liens and potentially 1.25 liens, has led to tightening up of documentation in regards. The cram up risks in restructurings. You've certainly seen, a number of other things where folks were perhaps in the past taking liens on proved reserves. It's now becoming more common to do it on acreage, as acreage become a larger portion of the value of the underlying borrowers relative to what traditionally in the past for a secured lender had been a PDP or 1P kind of a collateral base. So I think those are a large, number of the changes driven or find their way into deal structures and documentation as a result of the extenuated or extended downturn that we've experienced. It's certainly been also challenging with regards to kind of, come with hedge solutions and hedge decisions. Right. It wasn't too long ago you were certainly looking to do multi-year, minimum hedging. It's a different conversation when you're hedging at $80, $90 a barrel versus locking in at $42, $43, $44 a barrel. We want to make sure from a credit perspective, you want to make sure you're aligned with management in all regards, and so you just need to think through some of those issues to make sure that you're putting together the right structure with the right incentives, so everyone's kind of rowing the same direction there.
So kind of following on that, I mean, have you guys seen, obviously the, kind of the break-even points have been coming down in the various regions. What have you guys seen and kind of been the things that have been driving, those costs down?
Yeah, so I mean, some of on the break-evens, drilling days have come down really dramatically in some of these areas, right? It's just the learning curve. You're naturally going to go through the learning curve. You've certainly seen, better completions, and IP rates are certainly getting better and better, whether you go from, what folks are calling the generation 1 to 2 to 3 completion techniques or whatnot. I think some of it also, you certainly, the upstream side has benefited from the cost structure that the service folks were able to provide. Certainly don't see that as being, a permanent sticky. That'll reinflate on the other side of the price turn here. But I also do think you've had some efficiencies just through the fact that, as rig count shrunk and personnel shrunk, you were left with the best of the best, the most efficient, the most technologically advanced, most efficient rigs and personnel, and so you certainly benefited from that as the operators, and you'll certainly lose some of that, I think, as activity picks up again and gets spread a little wider.
But one thing we've also seen is, Joe mentioned these larger operators, major independents shedding non-core assets. Well, as those assets fall into the hands of, much more efficient, experienced, operating teams that have that can knock out a tremendous amount of cost, they're able to actually, on a same price per barrel, top line, they're able to cut out, massive amounts of LOS expenses. And I think we've seen that as a key underwriting factor for us as we put money to work, that we often need to believe in a management team's ability to come in and, take any major independent, out there that sells a non-core asset, and you've got one team focused on one asset. We've seen really, really interesting results take place, and that's encouraging for us to continue to put money to work.
Right. Yeah, and I'd add to that also, the last, maybe a few years ago, it was much more about holding acreage, right? And as folks have gotten a lot of the acreage, under their belt now, you are seeing more of a push to pad development, and that is lowering, break-evens as you're doing multiple wells, many as 20 wells plus on a pad. Certainly better, per unit economics on a single well site. Wow.
All right, so kind of our next question, I guess I put this as a really long question, but I think, really what I'd like to talk about is, obviously through the downturn there and the restructurings, there've been a number of people who were debt providers that are now equity owners, and I think you would expect as things improve, they're going to be looking to go back to their core purpose. How do you see kind of the impact of that, and when are you starting to see those liquidity transactions, and so how do you think that's going to develop over the in the marketplace?
Yeah, I'd say it's also driven, partly it's very specific to each company. In some regards, some of those creditors, they've traded out of the paper, right? Either going into bankruptcy, the guys who are more situated to have more of an equity perspective, or perhaps even after bankruptcy and exit, as to your point, Jimmy, to get back into credit rather than holding equity positions in a debt portfolio. Now, certainly there are other guys, probably a number of guys who now hold that equity, and you're right, they're not private equity, and they're going to look to find some kind of a exit. Whether it's sizable enough to do an IPO, certainly one option, or in many of these other cases, you'll probably see a lot of incentive to consolidate, right? Smaller companies and perhaps different companies consolidating either for cash or for equity, just to get to the scale and the size that they become more interesting for either a large-scale sale or to go public. But yeah, I absolutely agree. Guys who are holding private equity and debt portfolios longer term will look for that monetization opportunity, but I'm not sure how many of those guys are really pressured to do so enough, right?
I'll mention, just some specifics. What we've seen Lynn do is a great example of that. They really have been very active in the last 18 months, 12 months, both before, pre and post bankruptcy in the market, really selling down, significantly their assets and/or doing interesting, transactions. And so I think we'll definitely see more of that type of divestitures, near term.
Do you, when you look at that, and specifically kind of Lynn, with the, kind of the announcement this morning that they're doing, a big JV in the scoop and stack, do you see some of those types of transactions happening where they're, again, trying to get more scale with, kind of plan to take that, and IPO, something like that?
Yeah, I think so. I think that makes a lot of sense, right? In many regards, it is scale. If your exit is going to be some kind of a public transaction, you got to either get scale to go public, or scale so that someone who already has public currency finds it interesting enough to buy it out. That's those two obviously.
Yeah, you got to make the story right.
Right.
And Lynn, in its old format, just wasn't going to be that anymore.
Right. So really, kind of going back a little bit to kind of the OFS market. I know in kind of our business, over kind of, I'll say fourth quarter 2016 and early 17, we've kind of seen a fairly large uptick in kind of the deal activity that's out there. Just wanted to kind of talk with you guys and see what kind of things that you've seen as far as market developments in the OFS market.
Yeah. I feel like the OFS space is very much a haves and have-nots in some ways. If you're providing, cool tubing to the top 10 Permian producers, you're experiencing, you probably haven't even experienced anything. You've had year-over-year growth. but if you're, kind of a roustabout business in the
Right.
Marcellus, you're providing kind of the core oilfield service, it's much more challenging, to create positive EBITDA. So, naturally that leads to, in my opinion, either, consolidation, that you're seeing that both in the public and private spaces. And also I think, there's a real good equity story here, because some of these companies can be, acquired and or recapped at very attractive valuations relative to historic metrics. So it's a tougher debt story, to be honest.
Mm-hmm.
It's really challenging sometimes to get to craft a deal that works. But certainly I think consolidation and or recaps, and we're involved in a few right now where we'd be refinancing kind of really some recaps, which I think will continue to be as long as we stay below $50, I think we'll continue to see a lot of pain
Right.
in the OFS sector.
Yeah, I agree with that. It's very much, in most cases here, it's more of equity or risk profile. As Mark saying, the haves and have-nots. It's hard to go to the investment or credit thesis to fund ongoing operating losses. So it's an equity story. It's a consolidation story. There certainly are opportunities, in the right locations to provide credit if it's structured properly and well thought out. But it's definitely a challenging position right now.
One of the challenging things that we find when we look at OFS, and a lot of companies will point to book value. Oh, well, I got book. Well, and yes, I agree. That book value probably does exist, but really, if you had to go out and is it, what is the true OLV?
Right.
It's probably something well inside of book, and so which makes it more challenging. And not only do you have the cash flow challenges, you have sort of the asset valuation challenges. The OFS guys will sit there and stare at you and go, "You're an idiot for not. I've got $100 million in book value," and well, let's go put it up for sale and see what you get. And so it's just really challenging. Now we're more than willing to work with people, on that, but it does provide, interesting conversations. When you're trying to put certainly a debt deal together.
Right. So with that, have you guys seen, more with, kind of prices and kind of, but some of the OFS service prices have been rising a little bit, or
I think it depends where they are.
Availability, tightening, things of that nature.
Yes, I think obviously in the hot areas, but then you've also seen OFS companies willing to lock into longer term agreements with these larger companies at still pretty attractive, historically low
Right.
rates, just to ensure that they've an ongoing business. So I think you have seen rising rates, but that's really kind of just the cream of the crop areas. I think most of the OFS space is very challenged right now.
Right.
Yeah, I've heard some commentary on some of the hotter areas where folks have looked to do, versus well by well or pad by pad, try to do something more term, and some of the service providers are term pricing is actually higher than month-to-month pricing, which was the exact opposite of what you had a few years ago.
Right.
And that's solely predicated on the basis that rates are going to rise, second half of this year going into 2018, and service providers don't want to be locked into these lows that they're at right now.
Right. Okay.
We have our next polling question. Has your company completed an M&A transaction within the past 12 months? Yes, no, or not applicable? Please make your selection now. All right, and here are your results. Pretty well
50-50.
balanced.
So I guess, and I think we talked about this in a little bit earlier, but what do you guys see as far as kind of the IPO market in the sector, kind of in the coming 6 months, 18 months?
Yeah, I'd say, there's certainly, the queue is filling up, right? There's a backlog of guys trying to go public. A number of guys were filing S1s in the process until the markets kind of closed on them here in the last month. So you would have your normal, pipeline of deals, but it's being backed up now. So there's stuff, waiting to happen when the opportunity's right, when the markets are open. There'll be stuff coming to market. So I think there'll certainly be, IPOs coming. The other thing is we've certainly seen, earlier this year as well as companies that were planning to, go public, filing their S1s and then being purchased, right, prior to go public, whether it's private equity or the reemergence of the SPACs, was showing up again to kind of take these transactions down. But yeah, there'll certainly be some IPOs, pending the markets opening, but some of these guys that plan to go public probably won't because of other parties, get involved.
Right. Yeah. My answer is short term no. There's a queue for sure. I think you stay below 50 for the near term, you're not going to see IPOs. That's a generalization, but I think it's pretty accurate. And I also think some of these guys are filing S1s in an attempt to Joe's point, trigger an event, which has been successful here recently. Have you seen other companies that, get purchased pre-IPO?
So, and I guess there's always the question in kind of a commodity market like we've got today is, okay, well there's the kind of what the forward commodity markets are, and then there's kind of the price decks that your lenders are using in that, and how have you guys seen how that how is that comparing to kind of the forward market and what you're generally seeing in the marketplace today? Mark, you want to go?
Well, I'll say we underwrite to strip. And so it's got to work at today's price environment, and we do begrudgingly require our borrowers to hedge even in this price environment. Now, we can get creative about wide collars or three-way, but really we tend to enter into ask them to enter into swaps, and we do lock in a percentage of the PDP for some term. That's just proper credit risk management, but we do run flat 40 and $2.50 gas to see where it breaks, and but for Oryx, we definitely are kind of driven by the strip, and we tend to see banks doing a lot of different things, some above strip and some below strip. So it's hard to understand where they're underwriting right now. They're certainly not doing a lot of deals in my opinion, and so. I mean, look, it's an opportunity for the non-bank lender to be active, kind of sub 50. I think the disruption creates opportunity.
Right. Yeah, I think in most of the private capital side, folks are looking at strip, and then they'll run some sensitized downside cases. Certainly, the bank decks, they're just not as they don't reprice as quickly as the market.
Not dynamic.
Right. It's certainly not as dynamic. Price decks I've seen this week. On the crude side, probably about $4 north of each calendar strip year currently, and pretty close on gas, probably a little under for Cal 17, 18 to strip, but certainly higher than the strip for 19 and beyond years. But that's just a function of the strip. The market's moved recently. I would expect the bank deck to reset in the next few weeks to reflect that. They're just not as dynamic in repricing, but they tend to follow it. They tend to, historically been a hefty discount to the strip, maybe 15-20%, but then pretty close to strip the last several quarters at least, and then today currently higher than strip.
So, not to be the downer here, but I think we've seen a decline, a recent decline in the prices, and then it's going to tick back up over the last few days. If you don't get a sustainable price, in that $50 range, I mean, do we have more bankruptcies, coming our way?
Yeah, I think, in as far as it goes to restructuring, it feels like we're kind of in the 7th or 8th inning, right? If oil's hovering the 45-ish range, $40, $45, $50 range, for the majority of the folks that were distressed, they've already gone through the process. They've cleansed the balance sheet, right? So while they're not doing great at $45, they're probably treading water and surviving. Guys who didn't go through the restructure were probably stronger to begin with, and probably had either better assets, lower break evens, and will probably survive this as well. But if you do get a backup go back to the mid 30s or even testing 30 again like we had early part of last year, I think you're probably back into some double dips and some restructurings again.
Yeah, I think we're in the 7th inning in the E&P space. I think we're in the 3rd inning in the OFS space. I think there's more pain to come, which will spur, I think, mergers, recaps, consolidations. One thing I will mention, as far as some of these companies who have emerged, some of these E&P companies, I'm surprised, quite frankly, just how much debt these companies still have. We look at deals all the time. We're just like, I cannot believe that company still has $900 million of total debt, coming out of, what were these people thinking? Those companies really, I think, still are candidates, in a sub-50 environment or a sub-$3 gas environment, depending on, the nature of their assets for additional pain. And, it's unfortunate. But, yeah, I think but below 50, there'll still be more pain, certainly in the non-E&P space, OFS in particular.
Okay. Thank you. And before we go to the next polling question, I just want to encourage you, people of the participants in the audience, you can feel free to, put in questions as we're going through this, and we'll try to get to those as we're kind of going through the discussion.
And time for our next polling question. Has your company completed a debt refinancing within the past 12 months? Yes, no, or not applicable? Please make your selection now. And here are our results.
So, I guess it's kind of continuing on a little bit with the, kind of the subject here. With the downturn in the oil prices, are you guys, more pessimistic about, getting deals closed, or more optimistic? How are you guys looking at it with the downturn there?
Yeah, I wouldn't say pessimistic is the right word here. And like I was saying earlier, this is where private capital really provides value, right? Provides a certainty of execution. So certainly more opportunities for guys in private debt and the private equity spaces here. Certainly, companies who have the wherewithal to kind of, sit out and wait for a better environment. Some of these guys have probably been waiting for a while. Perhaps, delay a transaction, or perhaps the time frame they had set for a transaction execution extends a little bit to try to bring more folks to look at it. But there were transactions certainly getting done in the $30 price environment last year. Certainly seen some constructive transaction terms with kind of deferred contingent purchase price adjustments, triggered by commodity prices to kind of bridge that. Certainly see transactions that involve more equity so that the seller still was able to realize some of the appreciation on the other side of it. So I do think things will continue to get, transactions will continue to go, especially some of the larger companies who have made decisions, corporate decisions to divest in non-core. They're going to go through with those transactions. Subject to some kind of reservation price that they're being met.
Okay.
My answer to this question is no. I'm not more pessimistic. I think the right answer is we're cautious, but we plan and we are actively leaning in, here to the decline in prices, and want to use this as an opportunity to provide, additional non-bank, secured debt, to the private sector. I think one of the things that we've seen, going back to the question on the refinance, why you had a lot more no's, we've been surprised with how some of these banks will kick the can, redetermination to redetermination with their borrowers, and because we're typically there as the alternative. And either the management team just can't quite stomach, the non-bank lending kind of, cost of capital, even though it might be the best thing for them. The banks have been really, I've really been surprised personally to see them sort of, some of these private companies really continue to hold on for a higher price environment, and have been reluctant to, take action on certain credits. So maybe that's why there's not been as many refinances, done, in my opinion.
Okay. So kind of going on, I think, and this is, I'm not trying to be self-serving here, but, on the quality due diligence side, I mean, what are, not only, how important is it, but, what are the key areas that, for you guys when you're looking at, entering into a transaction, what are the key things that you're looking for in your due diligence?
So, I'll start with, some reserves for sure on E&P, and then, the financial, with the Q of E or a recent audit, insurance, environmental, and then of course legal, title are kind of the main areas that we focus on. One thing I want to speak to is in the OFS sector, I spoke earlier about book value versus OLV versus, really what's the market. That's a really tricky question to answer right now whenever you're looking at a transaction. And so you really need to make sure you're finding, because it's very difficult to find comps. They're all over the place, and you just got to be really careful with where you are going to play right now in the OFS space, just because there's just not good market intel right now on certainly asset values, in my opinion.
Yeah. I think a lot of the same things we'd be looking for, as well as more a fundamentals view on location, on midstream, on takeaway capacity in the environment. But to your question up there, how important is quality? I mean, it's critical, right? There's only so much you can do against a persistent, commodity, price environment. You certainly, take mitigating steps with hedging and such, but that's just, protecting cash flow in more of a limited time frame. But when you have a persistent, commodity, downturn against you, it's hard to, preserve your true fundamental underlying asset value in those headwinds. And so you really focus in some regards on things you certainly can control, right? Some of the things you can't control, such as that. But the items that if you miss something in diligence and you can't fix it, that's just a real professional miss that there's no excuse for. So quality due diligence is critical of going through it, because other things you can work through.
Right.
But if you miss something, if you don't have the title, you don't have the title. And,
Yeah, right.
Good luck with that.
The one thing I'll mention is, one of the things where we've had some success in putting money to work is just the situation where it's a larger company, a larger operator kind of divesting to a much smaller management team or a more efficient operator. And so, you have to be able to make the leap of faith, that your borrower, the acquirer, can actually, bring costs down, 33, 45, 50%. And, Jimmy helped me on one last summer, where, we had a borrower doing just that. And it's interesting, that borrower has actually over-delivered on expense cutting. And so that's where, really being able to have experts in the field help you, do that type of diligence is critical to success, putting capital work right now.
Okay. So I think we're kind of down to, the last question here is, from a standpoint of, kind of follow on from the due diligence thing is how important to you guys as lenders is a, kind of a quality audit on these businesses?
Yeah, I think it's critical, right? And especially specifically to Mark's point there about, selling an asset from a larger consolidated entity, really getting a handle on what the true allocated costs were, what the true cost of that field or that property, that basin is, when it's, layered upon layered internally, and really getting a breakout of that. But it's critical for the fundamental underlying, credit thesis, making sure the financial's correct, the audit's correct. And then it's just, from a true reputation perspective, Now, none of us want to be, going back to our investment committee, having to explain why the financials were wrong on the last deal we did. So this is critical for a whole slew of reasons.
Yeah, one thing that we see a lot when we bring up the audit side of things in a transaction, when we're putting money to work, is just sometimes we deal with, since we really deal with in the lower middle market, kind of the private companies. There's varying levels of sophistication. I think everybody's intention is good. I feel like that we deal with, but everybody's level of sophistication is different, and so having an audit partner who you trust and know and has experience dealing with smaller kind of middle market and lower market is critical. We've made the mistake of mismatching the wrong size audit firm with the wrong size client, and it just was a headache for everybody. So I think there are firms that are better, certainly at sort of the area of the market that I focus on for sure.
Right.
And Hein is certainly one of the ones that we like to see in any one of our deals.
Yep. Okay. Well, I think that has, got us to the end of our initial, panel. I would encourage if you've got questions that you would like to pose for the Q&A side, please submit, in the chat box at the bottom left corner of your screen, and we'll kind of take a minute break here and see, let things poll up, and then kind of walk through some questions here. All right. So as a first question we've got up here is kind of for debt financings, as a percentage of capital lent, what percentage can you allocate to the PUDs?
Yeah, I'd say for more of a, kind of a more of a conforming bank type of facility where you see this as more of a limitation, it's more of a, 25-30% of the borrowing base can be allocated to the PUD collateral and non-producing collateral. Otherwise, it's a really function of PDP. On more the true private side, it's hard to give any percentage to a specific part of the cap structure here or a particular asset. You really do look at the whole and the earning potential and the in many regards it's the average value as opposed to the PUD value kind of driving, and especially in this price environment here. At $43, $44, probably not a whole lot of PUD value in a lot of this stuff. So you can probably give more value to the acreage than not.
Yeah, I would say we're a total approved lender, so we're going to look at the entire 1P as we set sort of what our credit metrics are and what our advance rates are going to be. We can get comfortable with up to 50% kind of PUD value, and also give borrowers the ability delay draw feature to go ahead and develop those PUDs if we believe they're low risk or lower risk. Typically our borrowers, the acreage value is, if they're not in a really nice, good part of the oilfield, there's a limited amount of value for some of my guys.
Right.
Some of the deals I see, so it really becomes more of, just how attractive are those PUDs, and do we have enough conviction around them to lend to them, and when we do that, we typically do it in a delay draw kind of structure, which is kind of over and above our advance rate.
Okay.
So that's one way that we're competitive, obviously, versus the banks who generally, in this environment, aren't letting you develop PUDs, or certainly aren't increasing their advance rate, in order to drill those PUDs.
Right. So the next question we have is, has the oversight from the bank examiners eased up on your reserve-based lending?
No.
Yeah, no. I think the only thing that's changed, since they've set kind of the parameters, the banks have worked through to try to conform their portfolio, through borrowing base reductions or whatnot, or just to get their credits, to the degree they can, out of a classified status and more in line with where they need to be. But I don't think any of the rules of any of the parameters have changed at all.
Okay. I think the next question we have here is, any thoughts on, more overseas international projects?
We're focused on kind of the U.S. U.S. And to a lesser extent the Gulf of Mexico. We have enough opportunity set, just onshore and in kind of the Gulf to kind of keep us fat and happy right now, and so we're not currently looking at anything overseas. Although Oryx certainly, as a global firm, has the wherewithal to do so.
Yeah, I think there's certainly capital available out there, and a lot of the firms focused domestically here also have a global presence, and we'll certainly consider international projects. From a competitive perspective, some of those projects it's hard to compete against some of the real core stuff that's being done in the U.S. and the lower 48 right now. But there's nothing stopping a number of guys from looking at international deals from either a debt or equity perspective, and deals are still getting done out there.
Good. So I think the next question we have is, what's the easiest way to access the private equity market for a small E&P company?
I'd say it's not easy.
Yeah, probably the most important thing there is getting introduced to the right partners. Not every PE shop, not every private credit shop is the right partner for every operator, every company. And so it really is finding someone who has those connections or getting hooked up with the right advisor who can introduce you to the right scale. If you're looking, there's certainly PE guys focus in that 5 to 20 space, or 20 to 50, and certainly quite a bit larger than that. It's just, you don't have to worry about finding the right PE guy, but find the right PE advisor who has those connections. That may be you, Jimmy. I don't know.
Yeah, I agree. I think it's the easiest way for a small E&P company to have access to the PE market is to pick a sophisticated capital advisor who can help parse through the landscape of PE options and kind of match make the small E&P company to the right form of private equity, because the private equity guys, there's a flavor for everybody, and so the capital is out there. It's just, I think it really takes, even for these smaller guys, a real sophisticated, plugged in, well-known advisor, and I think that is oftentimes that's the difference maker.
Right. So I think that's all the questions we have. Mark and Joe, I really appreciate you guys taking your time to participate on this panel with us today, and thank you again.
Our pleasure.
Yeah, thanks for the time. Appreciate it.
Appreciate it, gentlemen.
Thank you, Jim, Jimmy, Joe, and Mark. Please, for the attendees, please check your inbox for a follow-up email with an evaluation form that needs to be submitted in order to receive your CPE certificate for the course. Thank you all for participating, and have a great day. Bye.